Okay guys, welcome to today's video. So I'll be using my tablet for today, right? I'm far away from home, so I'm not with my PC. I'll be using my tablet to do the video on TradingView, and I hope you guys really enjoy it. So we are going to be talking about stacking confluences, right, in SMC. Okay, stacking confluences in SMC. Now, confluences are like confirmatory or confirmation tools. Do I even call it tools? Or something you see that gives you an extra confirmation, right, before you have a confidence to take a particular trade. It means there are certain things you want to see, right, before you pick a setup. And so far, today is day 62. We have talked about different confluences, right, we can use in order to select a point of interest, what we need to see based on liquidity, based on point of interest that we need to take our trade. Now, the reason for this video is just to tell you that of course, there are different SMC setups and different way we can catch trades that are based on smart money concept. But in order, right, it's very important that you know that in order not to confuse yourself or to jam pack yourself with too much knowledge on SMC, you want to stick to 1, 2, or 3, right, method of catching entries based on still SMC that you just want to be trading that alone, right? You just want to be trading that alone, and you can also be profitable with that. You just want to pick 1 or 2 as long as it's appearing, and you're not the person that you're not the kind of trader that wants to over trade. You don't want to over trade. You want to pick 1 to 2 trades per day, 4 to 5 trades in an entire week, right? You can stick to one particular. I've talked about different, right? You saw me talking about. I think let me just type all the confluences we can use. We have. We've talked about OB, right, where you have order block, right, plus fair value gaps, right? It means you're picking your point of interest from order blocks and FVG. It means any other block you want to pick, right, you want to use to trade should have a fair value gap, right? Once another block has a fair value gap and you mark that other block, right, to use in trade, right, that's a confluence. And we can also have, say, okay, we also trade from 50% of what imbalances, right, 50% of IBM. That's a confluence. So you see a market moving from external liquidities coming back to an higher time frame, say 4 hours imbalance, right? The structure is correct. You can also use that. And you have another confluence of say okay, where you have structured liquidity, structure plus engineered, right? Anywhere you see that, right, structure plus engineered liquidity, right, when market at this point in time, now market is not, you're not looking at 50% imbalance, right? In order for you to catch your trade, you're looking at, say, the market create a form of structural liquidity, which we have. Where's that my path to? I don't normally use this part when I have my PC. Where is it? Okay, sorry guys. Okay, path should be here. Let me add it to favorite. Good, right? Which is on the basic SMC setup, you guys know, right? You have market sweeping liquidity, right, creating a protected low for you, coming back, create a form of engineered liquidity right here, and coming back, sweep the liquidity tapped into that point of interest at the other block below for a trade continuation, right? You guys know that this is one of the, say, the simplest, right, method SMC setup, right? Based on liquidity sweep, you understand, targeting a particular section of liquidity, and market mitigates it and moves, right? So you guys, let me take this out. Okay, don't even know how to use this tablet very well. Okay, so this form of liquidity swept, so this is structural. It can also be engineered, right? So any form, structural or both engineered, that's a confluence that you want to see before taking a trade. At this point, you're not looking at 50% level of imbalance, you're just looking at structural liquidity, right? When you're looking at 50% imbalance levels to take, you're looking at liquidity to take and liquidity target regions. Okay, those are also confluences that can be used. Let me take this out. So now, as an SMC trader, I've also taught you guys power of three. A lot of people can be looking at that also, using the PO3 strategy based on SMC. So they are all SMC, right? So let me just put this one here also. Okay. Of course, you know that in order for you to use any of these, right, one major confluence there that must be added to any of these is where is it? Is the fib level. So this is like when you're calculating discounts, right, slash premium. All right, let me put this in full. Now, whatever you're using, you must use your fib discounts and premium. Let me type that out correctly. All right, fib discount and premium levels. So it is a very, very important aspect, right? In order for us not to get induced. That's why whenever we have a swing low, a swing high, and we have a particular range that we are targeting the market to break either up or down, right? We mark out fib, use our Fibonacci retracement tools to get the discount and the premium zones, so that we can easily know which areas we are going to target for our point of interest. Now, all these confluences can be used in order for you to identify a particular, I think there are more, right? OB, imbalance, swing high, and we also have liquidity sweep and run, right? When market makes a sweep, say you have a particular high here, then all of a sudden market, instead of continuous structure, just sweeps the high and breaks below, right? And breaks below. Then there's a confirmation entry. You wait for another break of structure to happen. Why are you waiting for another break of structure to happen on the downside before you take a trade? Because market can be tapping into another bullish point of interest to a continuation. So when you see a pullback, you don't want to just catch trade, because this is the first market structure shift, right? So you want to wait for, say, another break of structure to happen. When that happens, you will now be able to catch trade for a pullback, because there's a market structure shift, there's not a break of structure. You want to catch a trade for a continuation to the downside, right? It's more safer, right, than just entering outside, okay, than just entering outside. So it's more and more safer than that. Okay, so you want to catch confluences like this. Of course, you would still use your fib discount and premium. Don't always forget to do that. It is very important, right? So these are confluences. Now, as an SMC trader, you can now decide the one that you normally see very, very well. Say you used to see those imbalances on 9 time frames, you mark it at point of interest. You're targeting external liquidity because you're using those ranges as internal liquidity, right? That falls under 50% imbalance, or let me just put it, liquidity to take and liquidity target, internal to external liquidity regions. Or you're waiting for structural liquidity to be swept, let market induce, then comes back to a particular POR and sweep. Or you're always looking for an order block that has FVG attached to it that you want to take trade off. We have talked about all these different methods. Or you are looking at the power of 3, or you're looking at a trend line breakout and SMC continuation. We have also talked about that, looking at trend lines when they break, right? You see market pulls up, create a market structure shift, comes back down, give you that continuation. For example, this is a bearish move, right? And market has been creating, say, a trend line, right? A bearish trend line like this, right? Then all of a sudden, when market comes to take out the trend line, no, that's not where I want to do it. Okay, let's delete that. So when market comes, I don't even know how to use this thing. You guys should just bear with me for today. When market comes to take out the trend line, right, it creates the market structure shift here, right? And the trend line has been taken out. So you enter, if market creates a structural liquidity for your engineered liquidity, you enter the pullback for a continuation to take out this structure. You can see most times when I post, I think was it 2 months, 3 months ago, I used to trade this particular method, especially on smaller time frames, say the 15 minutes time frame, where you check the confluence. You see market has taken out. Market will always want to go out to take out the highs of this trend line. So this is another kind of SMC setup you see, and you stack it as a confluence that, oh, if I see a trend line breakout and market is coming to give a retest, I would want to catch a continuation trade, right? So let me add that. Let me take this off. Oh, no, delete that. Let me take this off the screen. Out you go, nee. Out you go. Okay. So now if you are now good, right, you can stack all these confluence together, or you can focus on the one you always see, right, that your eyes can see, then you trade those ones, right? Because if you are combining everything together, you might not be able to be looking at power of 3, want to spot structural and engineered liquidity, wants to look for imbalance, wants to spot internal to external range liquidity, wants to be able to catch a valid POI, now valid OB that has swept liquidity and has an FVG, right? So you can write down all the things, the confluences you would see for you to be able to take a valid SMC setup, right? Then you pick one or two that, according to what your eyes can see on the chart, you don't need to know basically everything, right? You can stick to one concept and be trading that concept, and you would see it, right? If your mind is now opened to see, if power of 3 is appearing on the chart, you can see it. If there's a structural engineered liquidity, you can see it. If market creates those internal imbalances, where market taps into the 50% level of those imbalance and goes up to or down to target external liquidity, if you know that, if you go to 4 hours chart, you can identify those imbalance with the correct structural direction. Now, all these things, of course, they would not really work if you do not have what I called a correct directional, right? A correct directional bias. Okay, so these are 2 things you want to stack. You want to have a correct, now this is just like the king of all this, right? This is just like the king of all this. You have, once you know your directional bias, then you can pick any of these SMC confluences that you want to see on your chart. Then they must be lying, right? They must be lying across a discount or a premium level depending on the direction. So if the direction is sell, you'll be targeting premium levels for your entries. If the direction is buy, you'll be targeting discount levels, right? So you must have what? Directional bias. So it means before you even go and be looking for imbalance, before you're going to be looking for FVG, before you're looking for structural liquidity, before you're checking out power of 3, before you're looking at trend line breakout and retest on smaller time frames for entries, you want to know what direction the market. That's why I did a video yesterday, understanding the story that price is telling. If you understand the story that price is telling on that particular chart, right, you would know that, we are bullish, oh, we are bearish. And even if you are bullish or bearish, you will know the time frames. You say, the weekly time frame is confirmed bullish, but the 4 hours time frame is bearish. Why is the 4 hour time frame bearish? If the bullish and the weekly time frame is bullish, is because the 4 hours time frame wants to just go and make a retracement so that the bullish can continue. So you'll now understand on different time frames what they are doing. The daily time frame is bullish, but yet the 15 minutes time frame is bearish. That's because 15 minutes time frame is just going for a lower level, right, on the daily time frame, so that buys can continue or sales can continue, understanding the story. So if you can get the directional bias correctly, and when you are getting it, this is the fact, these are the two things. You get it correctly, and at the time you are getting the directional bias, hopefully it should not be the time market wants to actually change that direction. Yes, of course, market can be bullish, then all of a sudden market shifts, becomes bearish. Market can be bearish, all of a sudden market shifts and becomes bullish, right? So you'll be it will be very good that you caught the directional bias at the point of when market is still in this bullish trend, right? Because if you catch it when your market is reversing, then market will take you out. Then of course you would see that market has changed structure. Now we are bearish. Okay, that is when market taps into higher time frame key levels or has broken higher time frame trend lines, right? You know that higher time frame trend line has been broken, so there's a chance that market will trace into lower levels or retrace into higher levels depending on the direction, either bearish or bullish. So once that is confirmed, your eyes will now be like, okay, based on this direction, since we are bullish, because there must be a direction in your head. Since you have confirmed the direction, since we are bullish, let me look forward where liquidity is resting. Liquidity resting as imbalances, their liquidity levels, external highs, previous daily lows, previous daily highs, swing highs and swing lows, where liquidity is resting, that market would want to go and take those liquidity to fuel a continuation move or to fuel a reversal move. That's where you now be looking at all these confluences. Then whenever you now check those areas, you must now identify that they are under the Fibonacci discounts or premium levels before you have a confidence to now say, I can actually take this trade. And of course, you're targeting realistic targets, previous swing highs and swing lows, right? Where liquidity is, that's where you're targeting. If market takes out a particular one, you want market to retrace back to take out an external high or low, right? So that is how you do it. So you guys can now decide that, I want to stick with power of 3. That's what I see mostly on the chart. Then I'll be trading power of 3, accumulation, manipulation, distribution. I'll be trading it, accumulation, manipulation, distribution. I want to stick to I'm good with OB. I'm good with trading order blocks and fair value gaps. Boom. I'm good with trading imbalances. I love liquidity to target and liquidity to trade. Boom. Then if you're now, your eyes are very good, then you can see all these things in multiple, right? If this one is appearing, you can trade it. If this one is appearing, you can trade it. Then you can now go ahead, right? So that's just the essence of doing this video. And also you can now stack the confluences together. You are seeing a 50% imbalance level. That same imbalance level, when price shifted, it created an order block. The order block has an FVG. You can now stack those confluences together. It is also in the 50% or premium regions, right? It also created an engineered liquidity. So now stacking all these confluences together will now give you what we call a high probability setup. It means this particular setup I'm saying is high probability because of all these confluences are in check. Trend line breakout is there. It just broke out from a trend line. When it broke out from a trend line, it tapped into a high time frame imbalance. Market shifted, creating an OB, 3 candle move, FVG. Market pulled down, created an inducement that is a structure, that is an engineered liquidity. Now your OB is there. Everything. So stacking those all these confluences together now gives you very high probability setup. It means the chances of that trade playing out based on all these confluences you have stacked up together, it's now high, right? It is high, so it gives you beautiful trades. So you guys can write this down, right? If there are, I think there are others I've not even written here. right? We've talked about orders that are not even that are not on these confluences that are stacked, right? I think so, right? So you can write this down, and it's going to help you in your studies, because of course, as technical analysts, we trade past price actions. They are basically repetitions. If it does not repeat, then we have nothing to trade, because if you cannot see it, you can't trade it. But as long as you can see it, why won't you trade it? Right? So it's very important. So that will be all for today, guys. Yeah, just write it down and work towards it, according to what you can see. Right? That will be all for today, guys. See you guys on the next one.